Okay, let's continue with our discussion. We were doing problems on risk analysis and capital budgeting. We have broadly discussed one, how do you calculate expected NPV? How do you calculate standard deviation? What is coefficient of variation? Risk adjusted NPV. I think only two concepts are pending to be discussed. One is certainty equivalent approach, and there's something called a sensitivity and scenario analysis. Let's come to question 10. Oil Country Tubular Limited is considering an investment in one of the two mutually exclusive proposal, X and Y, which require cash outlay of 3,40,000 and 3,30,000 respectively. CE approach is used in incorporating risk. Current yield on government bond is 8% and this can be used as risk-free rate. Expected NCF and their certainty equivalence. Which project should be accepted? If RADR method is used, which project must be analyzed with higher rate? Discuss the advantages of certainty equivalent method. Now, see, this chapter focuses on the risk side of it. There's a chapter investment decision which focuses on the return side of it. From risk side, we had first thing called the standard deviation, then we had coefficient of variation, then we had RADR. Now, what certainty equivalent approach says is RADR said different discount rate for different projects. Certainty equivalent said don't change the discount rate and all. You will have to adjust the cash flow. For example, these are the cash flows and these are certainty equivalent factor. What is certainty equivalent factor? It basically gives you what is the probability of this happening. How much confidence do I have that this cash flow will at least come? So this is called uncertain cash flow. You convert this into certain cash flow. Certain means you are 100% sure that at least that much will come. So convert the uncertain cash flow into certain cash flow by multiplying with CEF. After that conversion is done, you will have to discount it at risk-free rate. Let's do this. Working note 1, computation of NPV. Computation of NPV. So I will have year. Cash flow will have 3 sub-columns. Cash flow will have 3 sub-columns. Uncertain cash flow, CEF, uncertain cash flow. Uncertain cash flow, certainty equivalent factor, and certain cash flow. You are going to convert the uncertain cash flow into certain cash flow. PVF at, you will discount now at the risk-free rate. You will do discounting only at the risk-free rate, not even risky rate, not even different rates for different project. We normally discount it at risk-free rate. Some question may say you to discount at different rate. That is, they may tell you to discount at risky rate. The only difference between RADR and this approach is in RADR, the discount rate will be different for different project. The discount rate will be different for different projects. So here the cash flows are given in the question. 3-year cash flow. The initial outflow is 3,40,000. Inflows are 1,80,000, 2 lakhs and 2 lakh. What we are required to do is, you cannot discount this. You cannot use this cash flows directly. If you use this cash flows directly and discount, then that's your normal NPV approach or the RADR approach. Under RADR, the only difference is project X will have a different discount rate, Y will have a different discount rate. So the certainty equivalent factors are, for the first year 0, it's always certain to happen. So we write 1, or you need not even write anything here. You need not write anything here. This is my initial outflow 3,40,000, 1,80,000 into 0.8. This is what you should take for discounting purpose. Your uncertain cash flow into the certainty equivalent factor will give you the certain cash flow. Use certain cash flow for the purpose of discounting. Use certain cash flow for the purpose of discounting. You cannot use your uncertain cash flow. So this will be discounted at 8%. At 8%, I do the discounting of this, and this will be called as the NPV of the project. Like this, you will have to do it for both the project. This turned out to be minus 7276. You will do the other project, whatever the NPV turns out to be. You will have to convert your uncertain cash flow into certain cash flow. Uncertain cash flow into CEF will give you the certain cash flow. Now, if at all I was following an RADR approach, which project will have a higher discount rate is the next requirement. If you follow an RADR approach, which project should be analyzed with the higher rate? Now, in order to answer this, I'm going to add the CEF. I'm going to add the CEF. The total of this is 2.4. The total of this is 2. 2.4 means this project wise more certain to happen. The certainty equivalent factor tells you how confident are you on the cash flows of the company. The total of the CF was 2.4, which means you are more confident in project Y cash flow as compared to the project X cash flow. This is more certain. More certain means less risk. More certain means less risk. So, if I am using RADR approach, project X will be discounted at a higher rate. Project X will be discounted at a higher rate. Project Y will obviously be discounted at a lower rate because X is considered to be a high risk project because the certainty equivalent factor is less. It's not on the basis of NPV. The NPV here is negative and positive. I'm not answering based on NPV. I'm answering based on this. The cumulative CF of 3 years is 2 and 2.4. Higher CEF means lesser risk. Higher CEF means lesser risk. Let's go to the last part, which is sensitivity analysis. In sensitivity analysis, we'll have two approaches. One approach would want you to find, see what is sensitivity analysis is. I calculate NPV of a project. The NPV is 5 lakh, 10 lakhs, 15 lakh. It could be positive. But people will keep saying that this is a risky project, this is a risky project. Now, why they keep commenting it's a risky project is this 5 lakh can become negative. When can it become negative? If there is an adverse movement. What is adverse movement? If selling price comes down, it's an adverse movement. Cost price goes up, it's an adverse movement. Fixed cost going up, adverse movement. Discount rate going up, adverse movement. Initial outflow going up, adverse movement. Anything which is going to negatively impact the NPV. Anything which is going to negatively impact the NPV is an adverse movement. So, though I have a positive NPV, but I'm little worried. That my NPV can become negative. So, one approach of doing sensitivity analysis is I want to know how much should the selling price fall. How much should the selling price fall so that my NPV becomes 0? How much should the selling price fall so that my NPV becomes 0? If it falls more than that, project will become unviable. If it falls more than that, for example, you say if selling price falls by 10%, NPV will become 0. There's a caution for me because it will become 0, and if it falls even more than that, NPV will become negative. Negative means you should ideally reject that project. So, one way of doing sensitivity analysis is finding out what should be the percentage change in these factors. What are the factors? Selling price, cost price, units sold, discount rate, life of the project. So, you have multiple factors which can be done. Anywhere the change happens, when do I reach 0? This is one way. The second way of doing a problem is they'll say assume a 10% variation in the input factor or a 5% variation in the input factor. So, they can give you some percentage and then tell you to do sensitivity analysis, or they may tell you to find out when will it become 0. Let's do question 11 where we are testing when will it become 0. PNR Limited is considering a project with the following cash flow: cost of plant 12 crore, running cost 456, savings 12, 14, 11. Cost of capital is 12%. Measure the sensitivity of the project to the changes in the level of plant cost, running cost and savings such that NPV becomes 0. Determine which factor is the project most sensitive to. So, I want to know when will it become 0. How much should be the percentage change? For this type of a problem, we are going to follow this year cash flow PV of DCF only, but with some changes. Year in cash flow, I will write these three items separately. Okay, plant cost, running cost and savings. I am writing them separately, not clubbing them together. We normally club them together and write a single cash flow. Plant cost is an initial outflow, running cost and savings you will club it together and write an in between cash flow. You normally club them together, but if it has to become 0, you will have to do a separate analysis. Cash flow, DCF also same three things separately written. Year cash flow, plant cost, running cost, savings. DCF, plant cost, running cost and saving. The discount rate given in the question is 12%. The discount rate given in the question is 12%. I am going to write the plant cost negative 12 crores. negative 12 crores. Running cost is also separately written, minus 4 crores, minus 5 and minus 6. Savings is 12, 14 and 11. So instead of clubbing them together, we have written this separately. You club it together, you can get the NPV of the project, but sensitivity will become difficult after that, calculation of sensitivity. So I am doing the present value of that, 12 crore into this. Running cost also the same way. And savings also the same way. Instead of clubbing them together, we are doing separate analysis of each of the item. Separate analysis of each of the item, and I am putting a total now. My NPV is basically sum of these three total, okay. NPV is basically the sum of these three total, that is NPV is equal to minus 12 crore, minus 11 crore 82 lakh 90,000 plus 29 crore 70 lakh 60,000. 5 crore 87 lakh 70,000. Now the reason for doing this separately is what you will understand now. I want to know when will the project have 0 NPV. I want to know when will the project have 0 NPV. If I go by plant cost, if I just take plant cost as an example, first factor is plant cost. NPV will become 0 if the value of plant cost goes up by 5 crore 87 lakh 70,000. If the initial outflow increases by 5 crore 87 lakh 70,000, NPV will become 0. NPV will become 0. So sensitivity percentage is equal to change by base. What is the change I want? 5 crore 87 lakh 70,000. Base is 12 crore. Can you tell me this? What is this number? 5 crore 87 lakh 70,000 divided by 12 crore into 100. 40.8. Okay. So the problem is if plant cost goes up by 48% broadly, NPV will become 0. If plant cost goes up by 48.87%, NPV will become 0. Any doubts on this? Factor 2, running cost. If the present value of running cost goes up by 5 crore 87 lakh 70,000, NPV will become 0. If the present value of running cost goes up by 5 crore 87 lakh 70,000, NPV will become 0. So sensitivity is equal to change by base into 100. 5 crore 87 lakh 70,000, base is 11 crore 82 lakh 90,000. If it changes by this level, again it will become negative. What is this percentage? 49 point. So this is the second factor. If your initial outflow, for example, this is an approximate answer, 49.68, you have done rounding off and all here. Just for an imaginary sake, I am adding 49.68% here into 1.4968, you will get a 0 NPV. I am adding 1.4968, 1.4968, NPV has become 0, 3,528, which is broadly 0 NPV, which is broadly 0 NPV. My NPV will become 0 if this goes up by 49.68%. Similarly, if the initial outflow goes up by 48.87, NPV will become 0. 1,26,000 is rounding off, broadly it will become 0. Third factor is savings. Again, sensitivity is equal to change by base. Change is 5 crore 87 lakh 70,000. Base is something we calculated, 29 crore 70 lakh 60,000 into 100. What is this number? How much? Okay. My project is most sensitive to a factor called as savings. That is, let's assume your input cost, your initial outflow goes up by 20%. Understand this, your initial outflow goes up by 20%, project will still be accepted. Project will still be accepted because it will not become negative, because the initial outflow should go up by 49% to become negative. Initial outflow goes up by 20%, project will be accepted. Running cost independent, I am not clubbing them together. Running cost goes up by 20%, still project will be accepted. But if savings fall down by 20%, if savings fall down by 20%, project will get rejected. If savings fall down by 20%, project will get rejected. So the project is most sensitive to this factor called as savings. The project is most sensitive to this factor called as savings, because if savings fall by more than 20%, project will get rejected. Clear? This is one approach. The second approach is based on NPV analysis. You will understand that in the next question. So unless you do this separately, you will not be in a position to calculate this. That is why we have done it separately, because for everywhere I wanted this denominator. I wanted the denominator. So that denominator is only possible if we do it separately. Okay. From the following details related to a project, analyze the sensitivity of the project to initial project, annual cash inflow and cost of capital. So they have given three factors: initial project, annual cash inflow, cost of capital. To which of the three factors the project is most sensitive? Variable is adversely impacted by 10%. Variable is adversely impacted by 10%. This is not NPV becoming 0. This is variable adversely impacted by 10. What is adversely impacted? Initial cost going up by 10%. How much is the change in NPV? Annual inflow coming down by 10%. What is the NPV? Cost of capital going up by 10%. What is the impact on NPV? So let's do this. Base NPV. Here I can do it in a table form also. PVF at 10%, DCF, year 0, 1 to 5, year 5, initial outflow is 2 crore, every year inflow is 60 lakh. Can you tell me 5-year annuity factor? Quickly tell me the 5-year annuity factor. $3.790. Okay, ठीक है. So I calculated the NPV 27,40,000. Now I want to know, when I change by 10%, how is the impact on NPV? So first change is adverse impact on cost. I repeat this calculation again. The only thing is this will be now into 1.1. So NPV falls to 7,40,000. From 27,40,000, NPV has fallen to 7,40,000. Percentage fall in NPV. Percentage fall in NPV is 20 lakhs by 27,40,000. NPV has fallen by some 73%. NPV has fallen by some 73% if there is a 10% change in the project cost. Your project cost was earlier 2 crore, we made it as 2 crore 20 lakh. What is the change in NPV? The next factor is what they have mentioned. What is the second factor they are mentioning? Which one? Cash inflow from 60 lakhs becomes 54 lakhs. From 60 lakhs it becomes 54 lakhs. So NPV from 27,40,000 has now come down to 4,66,000. From 27,40,000 it has come down to 4,66,000. Percentage fall in NPV. NPV has fallen by some 83%. NPV has fallen by some 83%. If there is a 10% change in, your, if there is a 10% change in your initial outflow, sorry, if there is a 10% change in your annual inflow. The third factor what they mentioned, cost of capital. The cost of capital today is 10%. increasing by 10 means 10 not becoming 20, 10% of 10% is 1%, so from 10 it now becomes 11. Can you tell me the cost of PVF annuity factor for 11%? Annuity factor for 11%. 5-year annuity factor for 11%. 3 point. So my NPV is now 2170. Again it has fallen. Again it has fallen. Now be very clear. There, whichever factor has the lowest sensitivity percentage, when it becomes 0, that is the most sensitive factor. That is the most sensitive factor. For example, in the previous question, that your annual cash inflow was the most sensitive factor because it had a sensitivity of some 18% something. When you go by change in NPV, listen this carefully. When you go by change in NPV, you look at which factor leads to maximum fall in NPV. Which factor leads to maximum fall in NPV? The factor which is leading to maximum fall in NPV is the most sensitive factor. There we are looking at what percentage change in the input factor will lead to NPV becoming 0. Here 10% change in input factor will lead to what impact on NPV? Whichever has the maximum impact. In this case, annual cash inflow is the most sensitive factor. Annual cash inflow is the most sensitive factor because this leads to 83% change in NPV. This leads to 83% change in NPV. Other factors does not lead to that much change. That does not lead to this much of change. Most sensitive to annual cash inflow. I am not doing some of the other questions. 13 is a good question to solve. It will be more time consuming because it follows WDV method of accounting. So it will take a lot of time for you to do. But the broad rule, what I have said, is what is going to work there. So you can try doing it. It will kind of revise your investment decision understanding also. 14, similar to the question we have done. Here you are looking at 2.5% adverse variance. We did a 10% variation. This question talks about a 2.5% variance in each of the variable. I think there are some 6 variables: initial capital cost, annual unit sales, selling price, variable cost, fixed cost and discount rate. For all the 6 factors you will have to do the sensitivity analysis. Okay. I think there is one extra question which I wanted to discuss. That's kind of understandable. If you go through it, you'll understand it. Okay. There is this best and worst case NPV. I just want to discuss one thing here. It may look like a very fairly simple, straightforward question. When you read it, you will understand. ASG Limited is considering a project Z with an initial outlay of 15 lakh and life of 5 years. The estimates are as follow: sales 9,000 units, 10,000 units, 11,000 units, selling price 175, 200, 225, variable cost 100, 125, 150, fixed cost 1 lakh, 1 lakh 50, depreciation is 70,000, corporate tax rate is 25. Assume the cost of capital is 15%. Determine the NPV in worst scenario, best scenario, base scenario and best case scenario. Okay, worst scenario, base scenario and best case scenario. In fact, I also did this mistake when I was going through the question. You look at the heading here, it says lower estimates, base estimate and upper estimate. Okay, the wording used there is lower estimate, base estimate and upper estimate. What they want you to find is worst case NPV, base case NPV and best case NPV. Base is okay, whatever is this. Okay, they want us to find the worst case NPV and the best case NPV. Normally I thought this is worst, this is best. That's what I also thought initially when I looked at the question. But the wording used there is lower estimate and upper estimate. Now listen, for the worst case scenario, selling price will be 175. That is fine. But the cost price will be 150. the cost price, the upper estimate, the cost will be the highest. The cost will be the highest for the worst case scenario. The cost will be the highest because they have not used the word worst case and best case. What they have used is lower, base and upper estimate. So your unit sold will be 9,000, lowest unit. Selling price will be lowest, but this will be 150 and this will be 2 lakh. This will be 150 and this will be 2 lakh. For the best case scenario, 11,225, but cost will be 100 and fixed cost will be 1 lakh. Cost will be 100 and fixed cost will be 1 lakh, because they have not used the word worst and best. If they had used the worst and best, I would have copied them as it is, because you see here best case is highest units, highest selling price, lowest variable cost, lowest fixed cost, lowest variable cost, lowest fixed cost. Be very careful, because the wording used in the question is not upper estimate, not best case and worst case. They have used the word upper estimate and lower estimate, and also they did not tell calculate NPV for the lower estimate scenario, upper estimate scenario and base scenario. They said calculate for the worst and best scenario. So worst scenario is highest units, highest selling price, lowest variable cost, lowest fixed cost. Best scenario, worst scenario, this will be lowest units, lowest selling price, highest variable cost and highest fixed cost. Any doubts on this? Any doubts on this? Don't take the scenario as it is. Don't take the scenario as it is. We're kind of done with 5 chapters. I'll move to a bulkier chapter now. I'll go to investment decision. That is going to take away a good amount of time. So we'll move to investment decision. We'll see how much we can complete today of investment decision, and then maybe in tomorrow's session I do management of working capital and dividend decision. Tomorrow the class may start a little late also. I think I'll be here in the academy only by 10:30 types. The class will be here only. Here it should be by 10:30 types or 10:40. Let's keep it as 10:45. Tomorrow's class will start at 10:45. That's the time. I plan to leave my home by 10:15 types. That's the time I can leave tomorrow. So let's keep it as 10:45. Tomorrow's class can even start at 11. Okay, I am not very sure. There's slight bit of tentativeness in my schedule, so I'm not confirming it, but let's keep it as 10:45 start in this place. Let's now move to investment decision. First you go through this theory. I'll give you maybe 2-3 minutes for you to go through this. I know, but tomorrow will be tough to do these two. Dividend will get over in 1 hour. Okay, the focus of investment decision is on calculating cash flows. If you calculate cash flows correctly, you will put in a format called as year, cash flow, PVF and DCF, and that will give you NPV of the project. In order to calculate cash flow, first I start with initial outflow. There are two items of initial outflow. One is called capital expenditure, second is called working capital. There's a capital expenditure and there's a working capital. The second is in between flows. The second is in between flows, where we start with units sold, selling price, get the value of sales, subtract variable cost, subtract fixed cost, you will get profit before depreciation and taxes, subtract depreciation, profit before tax, less tax, profit after tax, add back depreciation and CFAT. After CFAT, you may adjust for two items called as purchase of some additional machine or payment for original machine. There could be a purchase of additional machine, or there could be some payment for original machine which is not done, and you get the CFAT. Working note 3 is terminal flow. There are two items of terminal inflow. One is your net salvage value of existing asset. There's a difference between salvage value and net salvage value. You'll understand when we do a problem. And there's a recapture of working capital. We'll consolidate them together. Mostly calculate NPV. Some question other than NPV, you may do payback, discounted payback, ARR, your profitability index, IRR, anything can be calculated. Apart from that, I think this area also has something called as your capital rationing is there, modified IRR. Two more concepts are there. One is capital rationing, there's a modified IRR. There are few problems on replacement decision. Replacement decision works similar to your investment decision, but with certain changes to be done there. So there can be problems on replacement decision, EAB and EAC. I'll discuss them with the problems. Let's come to question 1. Go through this. Okay, the initial few question I'll focus on calculating only the cash flows. Okay, some question I'll do NPV, profitable index. I'll do one problem where all the techniques are done together so that you kind of understand it. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow, particulars, machine X, machine Y, machine X and machine Y, X and Y, capital expenditure, working capital. There are two types of outflow, capital expenditure and working capital. What's the capital expenditure of these machines? 1,50,000, 2,40,000. Working capital is 0. If at all the question gives you, we consider it, otherwise it's 0. So this is my initial outflow. Technically I don't need a step for this, but I'm just trying to ensure that you follow the same steps later on. Working note 2, in between flows. Now a machinery can do two things. One, it can bring extra revenues for the company. It can bring extra revenues. The second thing a machinery can do is it can cut down on cost. For example, if I buy a building for renting it out, it is a revenue enhancement because I'll earn revenue out of renting the building. Second thing is I may buy a building and I stay there. If I'm staying there, I don't earn any rental income, but I save rental expense. So in this question, there is a saving in maintenance cost, there's a saving in indirect material, there's a savings in scrap, there's a savings in wages. So all these are inflow of money. All these are inflow of money. So point number 1, savings and cost. Add all the savings and tell me. Savings only they have given. No? Whatever is savings. Whichever is savings, please tell me. Sorry. Maintenance is not saving. Sorry. These two are not. Savings in scrap and savings in wages, only two savings are there. Savings in scrap and savings in wages, 90,000 plus 10,000 and 1 lakh 20 plus 15,000. So savings is 1 lakh 35 less increase in cost. They are talking about certain expenses like maintenance, indirect material and supervision. All three put together how much? Maintenance, indirect material and supervision. How much? 25,000 and 35,000. Once you subtract this, you get PBDT, profit before depreciation and taxes. Few question may go ahead and say ignore taxes. Few question may say, not this question, but few question may say, if you are ignoring tax, PBDT is CFAT. If you are ignoring taxes in a problem, profit before depreciation and taxes will become cash flow after tax, because from this what you do is you subtract depreciation, subtract tax and add back depreciation. So depreciation is subtracted and added back. Reason is you have to calculate tax. But anyway, taxes are ignored, so we need not do any of this. In this question, tax, depreciation is there, tax is there. Depreciation minus 30,000 minus 40,000, PBT 45 and 60 less tax. What's the tax rate given in the question? 30%. Tax is 30%. PAT 31,542. Add back depreciation and CFAT. Add back depreciation and CFAT. 61,500 and 82,000. That's all. Our problem is over. Beyond that, how do you calculate ARR? How do you calculate present value index and all? I'll explain that in one question. All the techniques will do it together there. Okay, I think in question number 2 we'll do all the techniques. Let's come to question number 2. Management of P Limited is considering selecting a machine out of two mutually exclusive machine. Company's cost of capital is 8%, corporate tax rate is 30%. Details of the machine. Machine 1, let's just focus on machine 1. Calculate payback, discounted payback, NPV, PI and ARR of each machine. Advise the management of P Limited to which machine they should take it up. So let's focus only on machine 1. And we will try to calculate all these techniques. Let's first calculate the cash flow. Any problem, any technique you do, cash flows are the starting point. So working note 1, computation of cash flows. Computation of cash flow. I'll focus only on machine 1. Particulars machine 1. What is given in the question? They have given some number. What is that they have mentioned? Annual income before tax and depreciation. See, your working note 2, which is normally your in-between flows, it can start with revenues. Sometimes it may even start with PBDT. Sometimes it can start with PBT. Sometimes it can start with PAT. Sometimes the CFAT itself could be given in the question. Here, what is given in the question? PBDT less depreciation, PBT less tax, PAT add depreciation, CFAT. PBDT less depreciation, PBT less tax, PAT add depreciation and CFAT. What's the PBDT given in the question? 3,45,000. Okay, tell me the depreciation amount. Depreciation is 2 lakhs. PBT is 145. What's the tax rate? 30%. PAT add back depreciation and CFAT. Now in this question I am required to do all the techniques together. I'll tell you what are the columns needed for different techniques. Okay, so I'm going to do a one single format to calculate all the 5 techniques together. So year, cash flow, cumulative cash flow, these 3 are needed if you want payback. If you want to calculate payback, year, cash flow, cumulative cash flow. Then PVF, DCF, CDCF. PVF, DCF, listen, year cash flow and cumulative cash flow is needed for payback. Year cash flow, PVF, DCF, CDCF is needed for discounted payback. For NPV, you need year cash flow, PVF, DCF, all the four are there. For profitability index also you need the same thing. For ARR you need profits, depreciation, profit. This 8 columns if you put, you can calculate all the techniques except IRR. IRR you will have to do a separate calculation, because for IRR you need one positive NPV and one negative NPV. But these 6 columns can help you in calculating all 5 techniques. All 5 techniques. So year, 5 years. What is the initial outflow? 10 lakhs. Every year inflow is 3,01,500. So year and cash flow. Year and cash flow. Cumulative cash flow is the cumulative value of this. Cumulative cash flow is the cumulative value of this. I start with minus 10 plus 301 plus 301 plus 301 plus 301. I'll keep adding this. PVF, you know what needs to, what's the discount rate given in the question? 8%. So these are the PVF at 8%. DCF is cash flow into PVF. Cash flow into PVF. CDCF is the cumulative value of the DCF. Cumulative values of the DCF column. Cumulative values of the DCF. So I start with this plus this plus this plus this plus this, and I keep doing this. Cumulative values of the DCF. Depreciation can be only for year 1 to 5. I cannot have depreciation for a single day. Single day. Year 0 is a single day. PAT plus depreciation is cash flow. PAT plus depreciation is cash flow. So cash flow minus depreciation is PAT. This is not in fact needed in this question. Some other question it may be needed. This question I don't need this, because anyway I know what is the profit they are making, because I have done the statement here. The profit is 1,01,500 every year. So I know that, but anyway, if it's some other question where the profits are different for different year, you may have to calculate like this. First requirement is payback. Payback is equal to base year plus unrecovered cash flow of base year divided by cash flow of next year. For payback purpose, you will have to look at CCF column. For payback purpose, you will have to look at CCF column and find when it is negative for the last time. Find when it is negative for the last time. Started with minus 10, minus 6, minus 3, minus 95, positive. So it's minus 95 for the last time, which is year 3. Base year refers to the last year in which cumulative cash flow is negative. Year 3. How much negative it is? 95,500. How much negative? That's called unrecovered cash flow of base year. Unrecovered cash flow of base year. When is it negative for the last time? Year 3. How much negative? 95,500 divided by cash flow of next year, 301,500. 3 years, you divide this 95,500 by 301,500. Tell me how much it is. 95,500 by 301,500. 0? 316. Okay, 3.316. In this decimal portion alone, multiply with 12. This 0.316, whatever you got, you multiply with that alone with 12.
3.800.
How much?
3.800.
Or 3 years and 4 months. Broadly 4 months. The decimal portion I am multiplying with 12. You can even write it as 3.8 months also. You can multiply and then write that portion as 3.8 months also. 3 years and 4 months is the payback. Payback means you don't do any discounting there. Same thing, discounted payback, same formula. Look at CDCF and tell me when is it negative for the last time. 4th, how much negative it is? 1,431. And what is the CDs? What is the discounted cash flow of the next year? Not the normal cash flow. Unrecovered cash flow of base year divided by discounted cash flow of next year. What is the discounted cash flow? 205, 322. 205, 322. Tell me this answer. 4 point. It is broadly 4 years, I think. 1431 by 205322 is how much? 4.006. Okay. Can you convert that portion alone, multiply with 12? 0. After multiplication with 12. 0.0? Okay. So this is what it comes out to be, 4 years and 0.08 months. Broadly it's 4 years. NPV is equal to inflows minus outflow. NPV is equal to PV of inflow minus PV of outflow. Your inflow is all these 5 numbers, which is 12,03,891. All 5 numbers, inflow total is 12,03,891. So NPV is 12,03,891 minus 10 lakh. 2,03,891. 2,03,000. That answer is already there. That is the CDCF of the last year. That is CDCF of the last year, because CDCF was adding all this number. Profitability index means PV of inflow by PV of outflow. PV of inflow by PV of outflow. You can write this in times. You can write this in percentage, 1.203891 times, or you can do into 100 and write it as percentage. Into 100 and write it as percentage. Profitability index is otherwise called as benefit cost ratio. Sometimes they will use the word benefit cost ratio. Then you have ARR, accounting rate of return. There are 2 ARRs. ARR on initial investment. ARR on initial investment, which is average profit by initial investment into 100. Average profit is 1,01,500. Every year same profit. You have to take an average of that. You will add the 5-year profit and take an average. It's 101,500 divided by initial investment is 10 lakh into 100. 101,500 divided by 10 lakh into 100. This is called ARR on initial investment. Then you also have ARR on average investment. Formula is simple, average PAT by average investment into 100. Average PAT is 101,500. Average investment is opening 10 lakh plus closing by 2. Closing is equal to salvage value. Closing is equal to salvage value. Opening plus closing by 2. Opening is 10 lakh. Closing is, if there is no salvage value, closing is 0. If there is no salvage value in the question, closing is 0. So opening is 10 lakh, closing is 0. Closing is 0. So my average investment is 5 lakh. Average investment is 5 lakh. Opening is 10 lakh, closing is 0. There is no salvage value in this question. If there is a salvage value, you consider that as the closing investment and then take an average of that. I have not done IRR in this question. 3 you can manage. It's basically the same thing which needs to be repeated. Question number 4, go through it. I want you to calculate cash flows of project A, just the cash flows, nothing beyond that. That also is broadly given in the question, but some changes have to be done. So, in fact, just give me a minute. Okay, I want you to just tell me the initial outflow of project A and project B. Project A, what is the initial outflow? Project B, what is the initial outflow? Just calculate that. I don't want anything beyond that because the cash flows are given. Initial outflow of project A and project B. Just do the calculation of initial outflow. Project A, how much initial outflow? 5 plus. Okay. Model A 5 lakh is the initial investment. You will sell the old machine for 1 lakh. So 5 minus 1 will become 4. Utilities on the existing machine can be used if you use company A. Additional cost of utilities 1 lakh. So 5 minus 1 plus 1. 5 lakh is my initial outflow. For project B, 5 minus 1 plus 2 lakh minus 0.2 lakh. Plus 2 lakh and minus 0.2, I think it will be 5 lakh 80. 5 lakh and 5 lakh 80. I am not doing anything beyond that because the cash flows are given. I have explained you in one question how to calculate payback, discounted payback, ARR. IRR is something which is still pending. Just give me a minute. Can you write the cash flows of this question? Just want you to calculate the cash flows. Year cash flow, I want you, okay, I'm going to do IRR in this question. I want you to listen. When you do IRR in a problem, you need space for at least 8 columns, okay? Think about at least having 8 columns. You will need space for that much. Year cash flow. Start with year and cash flow. Have space for 8 columns. Think about that. I want you to write year and cash flow alone. Year and cash flow. Read the question carefully and write the year and cash flow alone. Year and cash flow. I don't want anything beyond that, okay? Year cash flow. We'll do IRR in this question. It's a 10-year project. What is the year 0 cash flow? Minus 70 lakhs. Minus 70. Year 1 minus plus minus 1 crore. Now they said net cash flow after tax but before depreciation. So they are saying cash flow is after tax and depreciation was not subtracted. That is nothing but cash flow after tax. That's technically your cash flow after tax because depreciation has not been subtracted by them, which is 25 lakh in year 2, 30 lakh in year 3, 35 lakh in year 4, 40 lakhs in all the years. 40 lakhs in all the years. Okay, now listen. I have to do IRR for this. This question, even if it comes in exam, it's easier. Reason is you have already done one NPV at 15% and you would have done one NPV at 10%. Maybe one gives positive, one gives negative and it becomes easier. Now what you need to do is for doing IRR, unless they give you table values below the question, you have to put a total of this. Just put a normal total of this. It comes to 1 crore 60 lakh, okay? The normal addition of this is 1 crore 60 lakh. I don't want you to listen for some time. Total of this is 1 crore 60 lakh. Divide by 10 years, the average profit is 16 lakh rupees. 1 crore 60 lakh is the profit without doing any discounting, okay? This is 1 crore 60 lakh is the profit of this project. I divide by 10 years, the average profit is 16 lakhs. Average investment is, there is 170 lakh of investment and 1 crore of investment. That's like an opening investment, okay? That's like an opening investment. You invested 1 crore 70 initially. Salvage value is not given in the question. So average is 85 lakh. It's not average of 70 and 1 crore. It's average of 1 crore 70 and 0 in the end. ARR on average investment. ARR on average investment. 16 lakh, what I did is I just put a total 1 crore 60, all this in calculator, nothing needs to be presented in exam. Please don't end up presenting any of this in exam. ARR on average investment 16 by 85. How much you get? 18 point? 2/3 of this number. There's no logic for 2/3 and all. 2/3 of this number. 12 point? Final IRR is expected to be closer to this number in most of the question. Final IRR is expected to be closer to this number. So I'll start with 13% for discounting. I'll start with 13% for discounting, because in an exam scenario, if they give you table values below, you're okay. What is exact IRR here is? Exact IRR is 13.2. The formula gave 12.54. The formula gave 12.54. So you will start at 13%. You may get a positive or negative, increase the rate or reduce the rate. This is only in a scenario where you are struggling to know what rate to start with. Some question they may give below the table itself something, then directly start. Don't present any of this in your notebook, because this is just for your purpose, what rate to start with. What rate to start with. Assuming I start at 13, okay? Not 15 and 10 which is given in the question. You would have done this problem 15 and 10 because they wanted NPV at 15 and 10. One positive, one negative automatically would have come. Assuming I do at 13%. Why I said I need 8 columns is, you will do 13 DCF. You get a positive answer, you will increase the rate. Again do, unfortunately again positive, increase the rate. So you should at least have space to calculate NPV 3 times. You should have space to calculate NPV. If you don't have space, then you'll have to again repeat writing year and cash flow, which will unnecessarily consume time. So at 13%, one by 1.13. The NPV sum 1,40,000. The NPV is 1,40,000. I'll increase it to 15%. I'll increase this to 15%. The only difficult part of IRR is knowing what rate to start with. That's the difficult part you will face. DCF. One positive and one negative. 1,40,000 is positive NPV, 15% has given me negative NPV. Somewhere in between is the IRR. I'll explain the formula now. Somewhere in between is going to be the IRR. At 13%, 1,40,000. At 15%, negative 11,82,000. Somewhere in between here, it will be 0 NPV. I want to know what is 0 NPV. So there's a formula called as, this is an interpolation formula, L1 NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. This is technically called as interpolation. Basically you are trying to find what rate in between will have 0 NPV. The lower rate is 13, L1 means lower rate. NPV at lower rate is 1,40,000 divided by 140, minus of minus will become plus 1182. 140 minus of minus, 140 minus of minus into 15 minus 13. L2 means higher rate, L1 means lower rate. Can you do this part and tell me how much it is? 1,40,000 divided by 1,40,000 plus 1182 into 15 minus 13. Into 15 minus 13. 2. Okay. So 13.21 is the answer. Exact answer is 13.2%, which is what the Excel gave. The material can have a different answer because there the gap would be higher. 15 and 10 is a higher gap. You should have as low as gap. This turns out to be 13.4. This turns out to be 13.4. Question 6. This is the cash flow. I want you to tell me the ARR on average investment. Just like this I did know. What should be the initial guess rate? I did this initial guess rate calculation where I put a total of the, listen for a minute. You will put a total of the cash flows, that will be called average profit, sorry, that will be called total profit, divide by number of years, that will be called as average profit, opening investment, closing investment by 2, average investment, ARR on average investment, and 2/3 of that, 2/3 of that. Quickly do this for question 6. Cash flows are there, minus 136 plus 30 plus 40 plus 60 plus 30 plus 20. Hello? Hello? Okay. No, I have first the problem. All of this has to happen only in the calculator. I don't want you to present anything in your solution there in exam also. Minus 136 plus 30 plus 40 plus 60 plus 30 plus 20 is how much? How much? What is the average profit? Sorry, what is the total profit? All 5 years put together, what is the total? Not 180. Minus 136 plus 30 plus 40. Minus also has to be subtracted. Minus has to be subtracted. That is the total profit of the project. That is the total profit of the project divided by 5 years, 8,800. That is the average profit. That is the average profit. Average investment is 68,000. Average investment is 68. 8,800 by 68,000 into 100 is how much? Into 2 by 3. So the initial rate can be 9%. This is what would have been presented here. The initial rate is 9%. The initial outflow, sum of inflows, total profit of project, average profit, average investment, ARR on average investment, initial guess rate. I don't want you to present this. There is no logic for 2/3 friends. Historically, the the IRR has turned out to be closer to 2/3. There's no logic. There are some questions where it will not be 2/3, it should be 3/4 and all. So there's no great logic for why we are doing 2/3 and all. This will broadly give you a number which is closer to your final IRR. There are problems where the final IRR can be far away from this number also. Here the IRR answer is 10.7. Your 2/3 said 8.63. So the variation is slightly on the higher side. The variation is on the higher side. It can be even higher also because we cannot exactly say. The only rule is just take 2/3 of that number. This will give you a number to start with. If you start at 9, I normally increase it by 2%. I normally increase it by 2%. So that the rule also says the gap between two rates should not be very high. So you cannot start with 10 and make it 20. That will be a very high gap. So in that solution, 10 and 15 was done. The answer turned out to be 13.40. Whereas the exact answer is 13.20. If the gap is lesser, your answer accuracy would be better. Let's come to 7. Following are the data on a capital project being evaluated by management of X Limited. Annual saving, 4 years life, IRR 15%, profitability index 1.064, NPV, cost of capital, cost of project, payback, salvage value, discount factor and their the discount factor and their PVFs are given below. Go through this. No, Vishwa, I don't think so. Mark will be reduced by ICA if there is less accuracy, but you cannot have a very high gap. Very high gap will be a trouble in exam. I'll come to it. Okay, now in this question, I have an annual cost saving, useful life is there, IRR is there, profitability index is there. I am required to calculate NPV, cost of capital, cost of project and payback. Now, first thing what I am going to do is, I am going to use this. IRR is the rate of return at which NPV of the project is 0. IRR is the rate of return at which NPV of the project is 0. So if you use 15% and discount, you will get 0 NPV only. That does not mean project has 0 NPV. IRR is the rate of return at which NPV of the project is 0. You will understand working note 1, computation of cost of project. Computation of cost of project, year, cash flow, PV at 15%, DCF, year 0, 1 to 4. Year 0, 1 to 4. Every year, what is the inflow they have given in the question? Inflow is given. What is the inflow given in the question? Annual cost saving, that's the inflow. Outflow is not given in the question. Outflow is not given in the question. At 15%, 4-year annuity factor is 2.855. 4-year annuity factor is 2.855. NPV has to be 0. So I multiply this. This can be 0 if this is minus 114,200. If this is minus 114,200. And this can be minus 114,200 if this is minus 114,200. In short, cost of project is 114,200. Cost of project is 114,200. Present value of inflows is not 114,200 because if we use that, NPV will turn out to be 0. Inflows is not 114,200. Cost of project is 114,200. Okay. Inflows is also showing 114,200 because we have used IRR for the discounting purpose. But what we use for discounting purpose is not IRR. We should use cost of capital. What can I do next? Which information can be used? Profitability index is equal to PV of inflow by PV of outflow. PV of inflow by PV of outflow. How much is the PV of inflow? How much is the PV of inflow? That's not there. 114,200 is not PV of inflow. Okay, that was discounting at 15%. PV of outflow, whatever be the discount rate, it will be 114,200. You can use any discount rate, doesn't really matter because for year 0 there is no discounting done. For year 0 there is no discounting done. So outflow will be 114,200 only, whatever be the discount rate. This will give you PV of inflow. How much is the PV of inflow? 1 lakh? 21,508. NPV is this minus 114,200. NPV is inflow minus outflow. NPV is inflow minus outflow, 121,508 minus 114,200. 121,508 minus 114,200. How much is the NPV? Okay, I go back to this calculation. Okay, I go back to this calculation. This was 114,200. Fine. I don't know this number. Okay, this is what I'm trying to calculate. Cost of capital is not given in the question. This is 121. How much you said? Inflow 121? 5 So the NPV was this, which means this has to be 3.0377. Your DCF should be 3.0377. In that below table, one of the rate will be 3.0377. Which rate? 3.0377 is 12%. So cost of capital is 12%. I'm not doing payback. For payback, you have to do year cash flow, cumulative cash flow. Year cash flow and cumulative cash flow. Initial outflow is 114,200. Every year is 40,000. See when is it becoming negative? Base year plus unrecovered cash flow of base year divided by cash flow of next year. Go through question 8. Go through 8. Now onwards the focus would be on calculating cash flows. We have done at least 2 questions on 3 questions on techniques. Now it will be only cash flows. Okay, I'm going to follow those 3 steps: initial outflow, in between flows, terminal flow. Consolidation and calculation of NPV is not which we are going to do. That is something which you can manage. A hospital is considering to purchase a diagnostic machine costing 80,000. Life is 8 years, salvage value 6,000, operating cost 7,500, revenue goes up by 40,000. It is outsourcing and is earning some commission income of 12,000 net of taxes. Whether it will be profitable for the hospital to purchase the machine. Working note 1, initial outflow. Initial outflow. There are two items of initial outflow: capital expenditure and working capital. Capital expenditure and working capital. How much is the capital expenditure in this question? 80,000. No working capital. So my initial outflow is 80,000. Initial outflow is 80,000. Working note 2, in between flows is the same amount for all the 8 years. Particulars and amount. It's going to be the same amount for all the 8 years. Now listen, what is the tax rate given in the question? What is the tax rate given in the question? No, what is the tax rate given in the question? Not given. Two choices, okay? Normally if tax rates is not given, I can ignore taxes. Second, I can take tax rate of 25%, which is your general corporate tax rate, and proceed ahead. This question, ignoring tax rate will not work, because somewhere they said commission income is 12,000 net of taxes. So taxes do exist. I'll have to assume a tax rate. So I'm assuming tax rate to be 25%. So the revenue this machine will give me is 40,000 less expenses. Expenses to run the machine is 7,500. PBDT 32,500 less depreciation. Calculate depreciation. I'll come to it. Less depreciation. I'll come to commission in a minute. 9,250. PBT less tax at 25%. This is assumption, okay? Tax is at the rate of 25% is an assumption. You can take any other rate also. PAT, add depreciation. I'll come to commission in a minute. CFAT. Okay, the question says this hospital is presently outsourcing this diagnostic work and is earning a commission income of 12,000 per annum net of taxes. If that word net of taxes was not there, this 12,000 is an opportunity cost which I would subtract here. I would subtract here because this is a loss for me. This is a loss. Earlier I was outsourcing it outside. Now I will subtract commission, but I will subtract it here, because commission is net of taxes. Commission is net of taxes. So I will subtract 12,000 here and incremental CFAT because of the machine. Because of the machine we are earning 14,687. Because of the machine we are earning extra 14,687. Alternatively, what I could have done is this 12,000 I divide by 75%. It becomes 16,000. You subtract here. You can, pre-tax, you subtract here, you will get the same 14,687 here. CFAT directly you get 14,687. It is an opportunity cost, but has to be subtracted at the right place, because this is after tax. That 12,000 is after tax. Then working note 3 is your terminal flow. There is nothing on the working capital side. For salvage value, we will have to calculate the sale value. I will explain this in this question, though it will not make any difference. Book value, capital gain or loss, tax paid or saved, NSV. The sale values after 8 years, we will sell it for 6,000. What is book value is value of this asset after 8 years of depreciation. We started with 80,000. First year 9250, second year 9250, third year 9250, fourth year 9250. So this value is 6,000. The book value is also 6,000. No capital gain, no tax. NSV is equal to salvage value. And your NSV is sale value plus or minus tax. Sale value plus or minus tax. It's not a continuation. It's not a continuation. Sale value plus or minus. If you are paying taxes, subtract that. If you are saving taxes, add that. I'm not getting into the NPV calculation part. That is something which is a formality. Go through question 9. Go through this question. Okay, a question where again we'll have to calculate cash flows correctly, because that's the most important part. The final requirement is, should the project be accepted or not. You calculate NPV, positive NPV, accept the project, negative NPV, reject the project. So let's do working note 1, initial outflow. Initial outflow. Particulars and amount. Capital expenditure, working capital, initial outflow. Capital expenditure and working capital, initial outflow. Read the question and tell me what's the capital expenditure. How much? 120. There is also an additional equipment which will be needed when? Beginning of the third year. So that will go to the in between cash flow. It will not be here. Minus 120, working capital is minus 15. Put together my initial outflow is 135. Put together my initial outflow is 135. Working note 2, in between flows. In between flows. Totally 8 years are there. Particulars. I can combine some of the years, but sometimes you may make a mistake, so I am writing separately. Some years combining is possible in this question. Particulars and 8 years. Particulars and 8 years. I am writing the format. I want you to do the cash flow. Units sold, revenues, less variable cost, less fixed cost, PBDT, less advertisement, I want you to do this. Get do this. Start with units sold, revenues, variable cost, fixed cost, advertisement, PBDT, depreciation on original machine, depreciation on additional machine, PBT, less tax, PAT, add back depreciation, CFAT, purchase of additional machine and revised CFAT. You will make mistakes at few places, we will discuss them. Go through it and try doing this. Units, I want you to do this, please try, please try. Please do it. Another minute and then I'll start discussing this. Okay. The 100% capacity utilization is 4 lakhs. Initially it will be 20%, so 0.8 lakh, then 1.2 lakhs, 3 lakhs for these 3 years, and then 2 lakhs for the last 3 years. The selling price is 100. I'm doing it in lakhs. Selling price is 100. Variable cost, PV ratio is 60%, which means variable cost is 40%. Variable cost is 40%. Fixed cost given in the question is 16 lakhs. Fixed cost is 16 lakhs. Advertisement is 30 lakhs in the first year, second year 15 lakhs, 10 lakhs for third, fourth and fifth year, and last 3 years is 4 lakhs. There is a possibility of combining some of the years. PBDT 2 lakhs, 41 lakhs, 154, 154, 154 and 100. Original machine we have purchased it for 120 lakh. There is no salvage value, so depreciation will be 15 lakhs. Depreciation will be 15 lakhs. New machine, when are we buying? Beginning of third year. which means third year also I'll provide depreciation. Third year also I will provide depreciation. So 10 lakh minus 1 lakh of salvage value 6 years, 1.5. 10 lakh minus 1 lakh by 6 years. 10 lakh minus 1 lakh by 6 years. PBT. If you read the first line of the question, it says it's an existing profit making company. It's an existing profit making company. So when you make losses, what you will do is you will set off against the existing profits, and this will reduce the overall tax outflow of the company. Losses will save taxes for the company. Losses will save taxes for the company. The tax rate in the question is 50%. So this minus of minus into 0.5. So indirectly first year alone it is positive. Every other year there will be a tax outflow. Every other year there will be a tax outflow. This is an existing profit making company. So first year you are going to save taxes. First year. There are going to be variants of this question. I will discuss them in some time. This year you are going to save taxes. So indirectly my PAT is lesser than PBT. My losses have reduced. My losses have reduced. I add back depreciation. I get CF 80. Which year are we buying the machine? End of second year. It's not the third year. Third year beginning. Your capital budgeting assumes all cash flows to happen at the end of the year. All cash flows. What is day 0 is nothing but, year 0 is nothing but beginning of year 1. It's only a single day. It's a beginning of year 1. So beginning of year 3 means end of year 2, and this will be my cash flow. 8.5, 18. I could have clubbed 3, 4, 5. I could have clubbed 6, 7, 8. We could have clubbed them together and written as a single item also. I am not doing the terminal flow. Once you are done with this, okay, I have not discussed even one question where we do finally the NPV. Once you are done with this, year 0 will come from the initial step 1. This will come from your step 2, and last year is step 2 plus step 3. Step 2 plus step 3. And whatever working capital is stuck on day 0, it will be recaptured. Basically, you are getting that money back. Whatever money is stuck on day 0, you will get that back. And net salvage value, you will have to calculate sale value less book value, gain or loss, tax paid or tax saved. So overall 16 lakh was there. Now variance of this question, I'll come back to 10 in some time. Just give me a minute. Okay, I don't know, I don't think so I have that question. One question will specifically say that losses cannot be set off or something. Just give me a minute. Okay, let me come to 14th question. We are going to solve the question. Let's just listen. Come to 14th question. PD Limited, an existing company, is planning to introduce a new product with a life of 8 years. Project cost at the end of years, no residual value, working capital. Everything similar to the question we had done. Everything similar to the question we had done. Advertisement expenditure. Okay, this has assume that losses cannot be carried forward. Assume that losses cannot be carried forward. There is one wording which said losses cannot be carried forward. If you see the previous question we did and this question, in the top they are not mentioning it's an existing profit making company. That question mentioned that it's an existing profit making company. That question did not mention anything about setting off losses or carrying forward. Nothing was mentioned. It just said existing profit making company. This question in the top just says it's an existing company, not an existing profit making company, and they have said losses cannot be carried forward. When you do your cash flow, you get minus 38 here. You get minus 38 here in the first year. Tax is 0. I don't give any tax benefit. I don't give any tax benefit because it's not a existing profit making company. If the existing profit making company word is not there, you are not giving tax benefit. You can alternatively also write saying that the company could have other profits and we are giving a benefit, but this question did not have that word, so we are not giving tax benefit. Alternatively, some question, for example, this question we did know. This question can say losses will be carried forward and set off over a period of next 2 years. The wording just says next 2 years. Then this year, zero tax. This year, zero tax. When it comes to next year, the profit in your books of accounts is 26. Taxable profit is only 13 lakh because this 13 lakh will be carried forward to the next year and set off, and it will become only 13 lakh of profit for the next year. If the question said losses have to be carried forward and set off, this is as per your Income Tax Act. Losses if have to be carried forward and set off. There are three types of problem. One, no set off, no carry forward. The question which I did an immediate set off. Immediate set off, basically tax, because there are other profits. The problem which I showed you there, what they said is losses cannot be carried forward. Unfortunately, losses cannot also be set off because I don't know whether there are existing profits or not. Third type of a question where they'll say losses cannot be set off immediately, but it can be carried forward to future years and then set off, carried forward to future years. So this year, okay, let me just take some number. Let me take it as minus 45, okay, for the time being. This year, zero tax. Minus 45 means zero tax because 26 lakh of profit, entirely it will be set off. Entirely it will be set off. This year, of the 137.5, I already still have 19 point, I already have some, how much? 19 lakh which is carried forward. So my taxable profit is 118.5 into 0.5. My taxable profit is 118.5 into 0.5. The question may say in 2 years you have set off. You are not able to set off in 2 years. That is lapsed. That loss will get lapsed and you cannot carry it forward further. Clear? Any doubts in this? So the question can be of three types. One, you do an immediate set off where the wording was like this. Existing profit making company. It's an existing profit making company. Make a loss, have a tax saving in the same year. If the question uses the word losses cannot be carried forward, then you don't have a choice of carrying forward. It also does not mention it's an existing profit making company. You cannot immediately set off also. Immediate set off not possible, carry forward not possible, so that loss is a loss. That's all. You cannot get any tax benefit out of that. The third scenario is you can carry forward, but you cannot immediately set off. Carry forward means when you make profits, set off at that year. Clear? Any doubts on this? Any doubts on this part? Okay, let's take a break of 15 minutes and then continue.